accountant, I'm a business consultant. I am also a tax strategist, and I've been in the finance industry for over 18 years. As a solopreneur, right, or someone who's an entrepreneur. Hello, and welcome to another edition of the Tax Takeover. Well, every week we do a deep dive into the tax code and provide you with loopholes that can possibly save you thousands of dollars in taxes. So, here on the Tax Takeover, we teach you how to tax plan like the wealthy. Remember, our motto is that the wealthy don't start planning once they become wealthy, but rather use tax planning as a tool to grow and shelter their wealth. So that's what the tax takeover is all about. So for those who are joining for the first time, allow me to introduce myself. My name is Tamara Andrews, and I will be your tax strategist and your tax expert for the duration of the show. A little bit about my background. I'm an accountant, I'm a finance analyst, I'm an enrolled agent with the Internal Revenue Service, and as an enrolled agent, I specialize in working with growing and established entrepreneurs who want to save more of their money, retain more of their profits, and build a legacy through the tool of tax planning, right? So today we are going to be talking about the home sale exclusion, all right? It's an exciting topic because everybody knows that when you sell a home, you may incur a profit, okay? And if you're a homeowner looking to sell your property, this credit can provide some fantastic benefits for you. All right, so let's dive in and we're going to explore the requirements and the advantages of this tax strategy. But before we begin, don't forget to hit that subscribe button and ring the notification bell to stay updated with our future tax saving videos. All right, so when you sell your home, if you receive more than your home is actually worth, or what you owe on the home, what you owe on the home, you experience what we call a gain, okay? However, if you sell your home and you receive less than what you actually owe, then you will experience a loss, okay? But if you experience a gain, in some cases, you will receive what we call a 1099-S. Now, you will receive this form from the lender or the real estate agent who was in charge of completing the sale of your home. Okay. Now, this form is used to report the proceeds from the real estate transactions, which also include the sale of your home. Okay. So even if you didn't receive a 1099-S, that does not mean that, oh, I don't have to report the sale of my home or the gains that I earned from the sale of my home. That does not mean that. Just letting you know that in some cases you will receive this form to file with your personal tax returns, and in some cases you may not. Okay. Now, when you receive that 1099-S, you're probably wondering, what do I do with it? You would definitely use that to report the income or the gains from the sale of your property. Okay. So the home sale exclusion credit is also known as the primary residence exclusion or Section 121 exclusion. All right. It's a tax benefit that allows eligible homeowners to exclude a portion of their capital gains from the sale of their primary residence. That's right, y'all. This credit is a great way to potentially save thousands of dollars in taxes, okay? So let's discuss some of the requirements now that I gave you some of the exciting news, all right? To be eligible for the home sale exclusion credit, you must meet these following requirements, right? One, you must have ownership and use. There's an ownership and use requirement. And this means that you must have owned and used the property as your primary residence for at least 2 years out of the past 5 years prior to the sale of the home, right? The second one is a frequency limitation. This means that you can generally, only claim this exclusion once every 2 years, right? So frequency limitation, you can generally only claim this exclusion once every 2 years. And then third, there is a capital gains limit. So the exclusion applies to any capital gains up to 250,000 for individuals and 500,000 for married couples. Okay? So get out your pens and paper. I want to make sure you take this recap. Okay? So again, it has to be your primary residence. You had to have lived in the home at least 2 years out of the past 5 years prior to the sale. Okay. You can only take advantage of this exclusion once every 2 years, right? And there are limits on the gains that you can exclude. 250,000 for individuals, 500,000 for married couples filing jointly. Okay. So meeting these requirements allow you to potentially exclude a significant portion of your capital gains from taxation, right? Now let's talk about the benefits of the home sale exclusion. But before we get there, I want to share with you a tax tip, right? There is a special rule for certain sales of surviving spouses. Okay, so in the case of a sale or an exchange of a property for an unmarried individual whose spouse is deceased on the date of the sale, the surviving spouse may claim a deduction up to $500,000. That's right. The surviving spouse can elect to claim a deduction up to $500,000 if the sale occurs no later than 2 years after the death of the spouse. And the other requirements were met too, right? They were living in the house 2 years out of the 5 years prior to the sale. So those other requirements have to be met as well, all right? So that surviving spouse can then claim that limit up to 500,000 instead of 250,000 for a single person, right? So, but what if you don't meet these requirements, right? What if you don't meet the requirements? You want to know, are there any exceptions, right? Can you still get the credit, right? There's hope, okay? There is an exception to ownership and the use rule, right? So there's an exception to the ownership and use rule. So as an individual, you can be treated as using the property as your primary residence during any period of ownership while the individual spouse or former spouse is granted the use of the property under a divorce or separation instrument. All right. So this is for individuals who are going through a divorce or maybe a separation. All right. So, because you are going through that and you probably have a divorce decree or a separation decree in effect, now you, as the individual, can be treated as using the property as your primary residence during any period in which the ownership, right, of the property was with your spouse, right, or your former spouse. So definitely understand that there is an exemption to the rule, right? And definitely make sure that you are talking with your lawyer and or your tax consultant, right? Someone like myself to make sure that you have all the proper documentation in place to take advantage of that loophole of that exemption, okay? There is also another exclusion. So, if you are someone who is a service employee, right, and you are on qualified official extended duty, this rule applies to people like members of the CIA, the Department of Defense, Department of Homeland Security, the Army, Navy, Air Force, Marines, etc., right? If you're a service member and you're under this exclusion that you're an individual who is serving at a duty station and the duty station is at least 50 miles from your primary residence, or while you're residing on government orders and government quarters for more than 90 days, then you no longer are held to the 5 year rule. But guess what? Now you get to look back 10 years. So, in short, your look back period of 10 years instead of 5 years allows you to show that, hey, I was living in the home for at least two of the 10 prior years before selling the home. So now you qualify under this exclusion. All right. So again, this is only for our service employees. And you have to be on qualified official extended duty. Your duty station must be more than 50 miles away from your primary residence, and you must be on that extended duty for more than 90 days. So I want to make sure that I lay all of that out. Again, consult with a tax professional before you elect to put this exemption in place. All right. So just understand that there is hope. There are some loopholes if you don't meet the other requirements. All right. So I hope that you are taking notes. I am going to now jump into some of the benefits. All right. So one of the most significant benefits of the home sale exclusion credit is the potential tax savings. By excluding a portion of your capital gains, guess what, y'all? Y'all keep more money in your pocket when you sell your home. So, for example, if you're a married couple and your capital gains on the sale of your home is $450,000, you can exclude the entire amount, right? And you don't have to pay taxes on it. See? That's how it works. That's what the tax takeover is all about, right? Keeping more of your money in your pocket. So, additionally, this tax strategy offers flexibility. Unlike other types of investment related taxes, the home sale exclusion credit allows you to exclude capital gains from the sale of your primary residence, meaning you can use the funds for any purposes you desire, whether it's buying another home or investing or even enjoying an early retirement, which I hope to do so one day. Okay. Moreover, taking advantage of this credit can have a positive impact on your financial future by reducing or eliminating taxes on your home sale. You can accumulate more wealth, y'all. Remember, I talked about that. We use tax planning as a tool to build our wealth, right? So it helps you achieve other long term financial goals, right? However, it is essential to note that tax laws can be complex. And so it's always wise to consult with a tax professional or tax strategist like myself to ensure that you meet all the requirements so you can maximize your benefits, okay? And they will also guide you through the process. They'll help you calculate what your potential savings could be, and they will ensure that you are making the most informed decision, okay? So it's important that you don't try this alone, all right? But I just want to thank you so much for tuning in today. I hope this was helpful. I hope that you found the information helpful. I hope that you were able to ask questions in the comment section. If you didn't, please put the questions in there and we will be sure to address them, okay? But don't forget, if you like the video, if you like the information, please give this video a thumbs up, okay? And please do not forget to subscribe, share. We want you to stay informed. Click that notification bell once again in order to make sure that you stay up to date whenever we're releasing another video. And follow us on LinkedIn. We share information on our LinkedIn page as well. And most importantly, please make sure that you are reaching out to us. Visit our website so you can connect with us and we can do a one-on-one call. I would love to meet with you to discuss your next tax strategy so that you can also become a part of the tax takeover family and put these strategies and tips that I share with you week over week in place in your life. Okay. So, again, thank you for tuning in, Five Family. I hope you have a wonderful and prosperous Tuesday evening. Until next time.